Hello everyone out there. How are you all doing? I'm Kate Hill, bringing you the best and unbiased and honest content on property, along with fantastic hints and tips. Today, stay tuned for all your latest property news. National home values were up 0.6% in March, breaking a 10-month streak of falls. Dwelling values were higher across the four largest capital cities and most of the broad rest of the state regions, led by a 1.4 gain in Sydney. Advertised housing supply has been below average since September last year, probably longer, with capital city listing numbers ending March almost 20% below the previous 5-year high. Purchasing activity has also fallen, but not as much as available supply. Capital city sales activity was estimated to be roughly -7% below the previous 5-year average through the March quarter. With rental markets this tight, we could be seeing some spillover from renting into purchasing. Although with mortgage rates so high, not everyone who wants to buy will be able to qualify for a loan. Net overseas migration is at record levels and rising. There is a chance more permanent or long-term migrants who can afford to will skip that rental phase and fast-track a home purchase simply because they can't find a rental accommodation. High rent levels are expected to persist until 2025, according to the National Housing Finance and Investment Corporation. It is their third State of the Nation's Housing Research Report, which has been released. While rental affordability has deteriorated across the board, the trends do vary a little between cities and regions. During the pandemic, rental affordability in regional areas and smaller cities experienced a considerable decline. For instance, in Sydney, the rent prices in several outer local government areas, they have risen by over 30% since the onset of COVID-19 in early 2020 up until January 23. Growth seen in these outer LGA areas is more than 3 times the increase in some inner city Sydney LGAs. Growth in the regions was bolstered by the tree change and sea change trends that saw so many flee from our cities, although this was already happening in some areas way before the pandemic. More recently, the tables have turned as rent growth falls in more regional areas, while certain large cities are seeing a notable increase in rent growth. Not the rents themselves, the growth of the rate. The rapid return of overseas migration, together with a supply pipeline constrained by a decade-high construction costs and significant increases in interest rates, is exacerbating an already tight rental market. Some property investors believe that the Australian property market is poised to recover after almost a year of declining prices in some areas. Some markets never actually declined, of course, but this is very broadly speaking. They believe that all the core indicators of a healthy property market are starting to emerge. While some pundits may disagree, rising interest rates, falling inflation, increased immigration, and a chronic shortage of housing will balance out the risks of an economic slowdown. So other pundits, like I've said, they predict a trough around the third quarter of this year with further price falls to come. There are some positive signs though, such as the national average home prices rising by about 0.6% in March, like I just said, before the Reserve Bank of Australia paused its monetary tightening after 10 successive rate increases. However, predicting the property market is risky, as CoreLogic's analysis shows that the house prices tend to fall about 80% of the time during periods of rising interest rates. Tim Lawless, who is the research director at CoreLogic, notes that this is not always the case. For example, housing prices fell 2017 to 2019 while rates were stable, while prices fell at the start of the COVID-19 pandemic but bounced back after interest rates were cut to emergency lows. He adds that there has been stabilisation in house prices despite the fastest rate hiking cycle on record, and it is still looking more likely that we are or approaching the peak of that rate hiking cycle. So this is likely to instill renewed confidence in decision making, such as buying or selling a home. So while he thinks that it is still too early to call a trough in the cycle, a pause or peak in the rate hiking cycle is a positive for the housing sector activity. However, household capacity to borrow is at about 27% lower than a year ago, limiting how much new borrowers can afford. The number and value of mortgage commitments are another useful indicator. The value of home lending fell about 0.9% in February, which is the smallest monthly drop since last May, when the RBA began raising rates. National residential property listings increased more than 14% during March compared to the previous month. It's still very, very low, right? New listings increased by around 7%, while older listings greater than 180 days were up by around 5%. However, CoreLogic do warn that an increase in properties for sale will be the real test of the market. Obviously, because without that commensurate lift in purchasing activity, higher supply could quell this new, more positive trend in housing values. Consumer sentiment jumped more than 9% after the Reserve Bank of Australia paused its interest rate rise, according to Westpac. But sentiment needs to improve substantially before getting back to average levels. High and increasing demand, as well as the total listings below long-term averages, is one of those key reasons why the housing market has not corrected more than feared, predicted and announced, and all that other blah, blah, blah that we read in the press. Australia is facing a significant housing shortage, like I have been talking about, with the National Housing and Investment Corporation predicting a shortfall of over 100,000 dwellings. The NHFIC is forecasting around 148,000 new homes needing to be built this year, which is expected to fall to 127,000 new homes next year. On the demand side, the NHFIC says more than 1 million new households are likely to form across Australia from 23 to 33, driven by the rapid return of overseas migration. SQM Research reports a national rental vacancy rate of 1.1% at the end of March, which is likely to have more of a profound impact on first home buyers and renters. Foreign investors are currently being discouraged from investing in Australian property, but data shows they are not crowding out the market. The Foreign Investment Review Board reports that just 3,196 foreign buyers were approved in the first 6 months of 22 to 23. Now that's down from about 5,400 approved proposals for the full year 21 to 22. In 21 to 22, foreign buyers represented about 3% of all transactions on new property and less than 1% of total property sales. Although foreign investment policies are necessary to regulate the foreign investment in Australia, the approach to foreign investment does need to be rethought. As residential real estate represents such a small portion of overall foreign investment, the country needs more new homes to be built. And currently, policy settings rely heavily on demand-side instruments, such as first home buyer incentives, to get people into a home of their own. However, there are supply-side measures that need to be considered to increase the supply of affordable housing. For example, Western Australia, glorious WA over there, allows all buyers, including foreign buyers who meet the criteria, to be eligible for a rebate of stamp duty paid on off-the-plan unit or apartment purchases, encouraging foreign investment in housing would be a sensible measure to boost supply and help ease that current rental shortage, which is becoming a desperate situation for many Australians trying to find a home in which to live. I will keep you posted as always on all things property from around Australia as our year progresses. Don't forget to hit that like and subscribe button if you're enjoying all the free content, and I will see you soon. Bye.